Welcome back. So adjustable rate mortgages, or in other words, an ARM loan. What this is, so a lot of people think these are very risky loans, and that's because back in the mortgage meltdown, ARM loans were very, very different than they are today. Oftentimes you would see ARM loans that were fixed for only like a year, and they didn't have a cap on them, right? So they could just balloon to any amount. I mean, it was crazy. Mortgage rates got up into the double digits easily back then on these adjustable rates. Well, our industry has learned a bit from our past mistakes. And today's ARMs, or adjustable rate mortgages, are really, I mean, in my opinion, they're not risky as long as you understand what you're getting yourself into and you are planning for the future. So the reality is these loans are very similar to a 30-year fixed mortgage because they're a 30-year mortgage. So it's not like you do a 10-year ARM and you have to pay that loan off in 10 years. That is not the case at all. It's still on a 30-year mortgage amortized over that time. So the payments are still affordable. The big difference is the rate is not fixed for the entire 30-year term. It's only fixed for, it depends. I often encourage, in fact, I almost never recommend doing anything less than a 7-year ARM. That's just my personal opinion, because a 7-year ARM gives you a very long period of time to get out of that ARM. You know, the fact is, historically and statistically speaking, most homeowners in the US will change their mortgage between 4 and 7 years. So the likelihood of you even being in the same mortgage for longer than 7 years is very, very low. So when you know you're on a mortgage that's a 30-year mortgage and the rate is fixed for 7, the other one that I often recommend is 10, which is even more certainty. And sometimes the 10-year ARM can be the same exact rate as a 7-year ARM. So that's why I like the 10-year. It's just more certainty for really not much more cost. But the reality is, based on statistics, you could get into this mortgage and never even face the possibility of the rate not being fixed, right? Because if you're in there for at least, or if you move or refinance in less than 7 on a 7-year ARM or less than 10 years on a 10-year ARM, you never were exposed to additional risk because the mortgage is now gone, right? You get a new mortgage. And with economics the way they go and the cycles that we experience, oftentimes you can refinance and also taper on the appreciation of homes. That also gives you the ability or the need to refinance for a bunch of different reasons. Maybe you won't sell in that 7 years, but you'll refi because values have come up and you'll want to remodel, or you'll want to buy a different property. Or perhaps you do sell and you move somewhere else. But these rates are fixed for a certain period of time. And for that reason, as long as you're strategic and paying attention to the terms on the loan and what you need to do, you can get out of that adjustable rate mortgage before it even adjusts. Now, beyond that, say you're in the loan long term. Say for some reason you have no opportunity to refi, or you don't sell, you're still in the ARM loan once it hits the adjustment period. There is a limit to how high it can adjust. Now, every program is different, but there is a limit. A very common limit is either 2% adjustment on the first adjustment. So that means that, say you do a 7-year ARM, on the 85th month, so that's 7 years and 1 month in, that rate could adjust by 2 points higher. So if, just for example, say you get a 4% rate on an ARM and it adjusts on month 85 because you haven't changed the mortgage or you haven't moved or sold the house, that could go up to maybe 6% on that ARM. Some of them are a little more risky. For example, some of them have an initial cap of 5%. So that's significant. That's what I'm saying. You need to be mindful of what the terms are in detail on the ARMs so you can make the right decisions and have a significant period of time to plan to get out of that ARM if it becomes something that you feel nervous about. If you're on a 7-year ARM and you intend to be in the home long term, we may want to be lining up a plan to get you out of that mortgage if you're not going to sell before that 7-year hits. However, me being in the business, I have a unique advantage because I'm constantly watching this stuff. But from my perspective, my personal home ownership, I've had more adjustable rate mortgages than I have had fixed rate mortgages. And that's because these ARMs oftentimes can be lower in rate, meaning lower payment, than a 30-year fixed option. Not always, not all programs, but oftentimes you can capture a lower rate and a lower payment for a certain period of time, like 7 or 10 years, for example. There's other ones, like a 5-year, for example. There's a 5-year ARM. But you can save money during that time, and if you're paying attention and you kind of understand what your goals are, you can strategically ensure that you're not exposing yourself to more risk, even though it might seem more risky in the beginning. Today, as it sits, ARM loans, because mortgage rates have been so low, many ARMs are actually not lower than a fixed rate mortgage. But on jumbo loans in particular, ARM loans can be dramatically lower than what the fixed is. So this is not a straight arrow. You can't make a decision saying, yes, I want an ARM, or yes, I want a fixed. I think it's something you should investigate, educate yourself on, and just understand your options, knowing that it's not this scary monster that we all think it is because of what we saw in the mortgage meltdown. There are legitimate options that do not expose you and your family to unnecessary risk. So educate yourself on these. I hope this is helpful, at least gave you some more information on these. If you want any other details or have additional questions, please feel free to call me. I'm available for you. But thank you for tuning in. Please share, and we'll catch you next time.